Hi, I'm Patu from freefincal, and in this video, let's take a look at how to track a stock portfolio at simplywall.st. Remember that I had introduced this website while talking about the SIP in Hindustan Unilever, and I had shown how you can track the portfolio holdings, the CAGR, the dividends, etc., and so on. This time, I want to show you the kind of insights that you can get in the stock portfolio, and for this, I'm going to use my own stock portfolio, and you can see in my audit link, I'll leave the link below. The stocks I have are listed. Hindustan Unilever and HDFC Bank almost are 50% of my stock portfolio. I'm trying to rapidly build the stock portfolio with relationship to my equity funds. As of now, it's about 7%. So if my equity mutual fund portfolio is 100 rupees, my stock portfolio is only 7 rupees. So it's quite low, but I want to build that up as quickly as possible, as much as possible. And I'm concentrating on solid, good companies which are low volatile, and I'm also concentrating on high dividend payers. So my goal is to invest in low volatility stocks as well as low beta, low volatility stocks, as well as companies which are offering a good dividend. And my goal is to try and increase the dividends that I'm getting. Close to as much as possible, close to my monthly expense. As of now, my the total dividends I have received is about 10% of my monthly expenses, and my stock portfolio is really much of it. Although the first few investments I made are a couple of years old, I have not been seriously investing until May last year. So only from May 2019, the actual money that flew in, that went into the stock portfolio became significant. Therefore, there's really no point talking about compounded annualized growth rate, CAGR or XIRR or so on. As of now, the absolute return on my portfolio is 21.3% before dividends. It's 0.78% comes from dividends, and totally is about 22.07%. This you can get from the simplywall.st. This is I am using the investor plan, which is a premium plan. I am told that the mobile version is free with some limited features. I don't know what features are not available and so on. You can explore it. Let's take a look at this. I'm trying to. So what I've done is the same window. I've opened it thrice in 3 tabs. So I can. I don't want to show you my the personal money invested and so on. Let me try to do that as much as I possibly can. Alright, so this is the first window, and I'm going to show you. This is the very bottom of the actual portfolio page. So we're going to scroll this up, and you will see the stock holdings that I have, and you can see the annual contribution to the dividends that are paid. And I think this is the annual contribution. This is not the actual dividends that I've received. What this means is, if I had held these stocks for 1 year in the same proportion that I'm holding now, the total dividends would be 10,267 per year. That is not the dividends that I have got, but if I had held it in the same proportion for 1 year, that would be the kind of dividends that you get, 10,000 per year. Not bad, not bad, but you wanted a lot more, but it's not bad at all. And next is the debt to equity ratios. So you can see here that in my portfolio, the total equity is about 91%, and the debt is about 8%. So that means that typically the companies that I'm investing is they don't have too much of debt, and they're solid, robust companies. Next, you have the that's the portfolio debt to equity. That's about 8%, which is fairly low financial health. Then next you have is the return on capital employed. That is how efficiently the company is using its capital. ROCE is, I think I have to look it up. I keep forgetting these things. ROCE is essentially earnings before interest and taxes divided by the net assets. Net assets is shareholders' equity minus the debt. And you can see the ROCE of my portfolio is 51.1%. That's kind of high, but okay, not bad. I think that happens when the debt is low. Yeah, I think so. Yeah, maybe wrong. I don't remember these things. I have a nice calculator for valuing a stock with all these balance sheet terms, but I can't remember a thing out of it. Then you have return on assets. Return on assets is net income divided by equity assets plus debt assets. This is not, I mean, it's not a very commonly used thing, but the ROA is 16.8% compared to the market. Market, I think, is Nifty or Sensex, something like that. I have to go check it up. I forgot to do it last time. It's fairly decent, I think. So I mean that means that, I mean, it's like a good company will use both debt and equity assets very well. So ROA is one type of profitability measure. ROE is a net income divided by net assets. That is only that is shareholders capital minus the debt. So this is net income divided by shareholders capital plus debt. So both of them should be reasonably high. ROA is high for my entire portfolio. The ROE, the return on equity, is 40.5%, which is kind of atrociously high at the moment. It may not be so high with time and so on. The market is about 8.8%. The past performance, that is, if I had held this portfolio for 5 years in the same measure, in the same weights that I'm holding now, the historical annual earnings growth would be about 6.8%. And you can see the earnings growth, the future average, past average, etc., revenue growth, earning growth, what you've got in the past, what you've got in the future, what you can expect. So the past is about, if your revenue growth is about 11%, future is 12%, past earnings growth is 12.4%, future you can expect 11%. That's an estimation. You shouldn't 1 to 3 years. So that's like over the next couple of in the recent future. Don't read too much about it. I mean, if this is alarmingly low, that means you're holding bad stocks. As long as it's reasonable, it means you're holding good stocks. That's all. Next comes the valuation measures. People are going to really get annoyed with these kind of valuation because the price to book value for my portfolio is 22.3 times. That is extraordinarily high compared to the market in general, or in general. The PEG ratio, which is the PE ratio divided by the earning growth rate, that's 3.2x. That it, people will say, all these fans of value investing will say, it has to be close to 1, it has to be close to 1, and so on. Oh no, I honestly don't care. I mean, I'm buying that kind of stocks. I'm buying very expensive stocks, and the markets think of them as expensive. They're good, solid companies, and the market treats them as expensive, and I don't mind buying it as long as they're low volatile. That's the way I mean, I don't care about all these measures. I mean, it's so annoying. These valuation measures really piss me off. Price, that's the P ratio, price divided by earnings. That's 44.9x. That's very, very huge. I mean, you can't hold a portfolio. See, buying value stocks is one thing. So let's say somebody, a great value investor who has got a value, who purchased only value stocks. If you look at the PE of their portfolio 5 years, 10 years later, it need not be a value portfolio. Those value picks may have come good, and the PE must have gone up, and the PE must have expanded, and the person must have got the benefit. So you can't say portfolio should be low value, low PE at all times. That's stupid. I mean, only a value mutual fund will do that, and you can see what happens to them. Oopsie. So what happens to them there? I showed you some of my numbers. So you can see how value funds perform. So that's the first segment. Then come the numbers and so on. And the second part, I should be a little careful here. So you can see that's the valuation is 44.8. Then you can see the diversification across industries in terms of percentage. The stocks I hold about 38% of household and personal products, 27% banks, and then the sub divisions of that, and so on. And then the last bit, which I think some people asked me, this is the market, the last 5-year beta of the market, and this is the beta of my portfolio. It's about 0.24%. So you can see there's a bed here, a person sleeping peacefully here, and this is like a violent thunder. Only one of my stocks, which is Vedanta, is kind of highly volatile. All the other stocks that I hold are significantly having lesser volatility than the market. That's the way I've picked them, and I like low debt companies which are expensive. I don't mind expensive companies which are trading close to the lifetimes is also okay, or always close to the lifetime also. High is also okay. Low volatility, expensive, sometimes dividend players. So that's the way I do. There are other numbers, but then I will have to reveal my actual investment numbers. I can't do that, but I've shown you my absolute returns and so on. This don't matter too much. Don't worry too much about it. Don't get too hung up on this. I mean, I don't spend too much time on buying stocks. I just buy good companies and just leave it at that. And I have the patience to do it. Also, remember, I have more or less my financial goal planning is in place. After that, I'm investing in stocks, so I have that much less pressure. So explore simply wall.st, sorry. There is a screener available. We'll probably play with the screener in another video. I have no tie up with simplywall.st. I'm just doing it on my own. This is not some affiliated video or an advertisement.